All right, let's put on our detective hats today. We're going to treat the financial market not like some boring spreadsheet, but more like a crime scene, you know? One that's just full of puzzles, mysteries, and hidden clues waiting to be found.
So that's the big question, isn't it? What secrets are really hiding in all those numbers? Because the market, it isn't just a bunch of random noise. It's this complex web of information, a whole series of signals and tells. And if you know how to look, you can actually decode what it's trying to say.
And how are we going to do that? Well, every good detective needs a toolkit, right? For us, that toolkit is financial models. And look, forget about dry, boring equations. Think of these more like our magnifying glass or our fingerprint kit. They're these really powerful frameworks that help us connect the dots between risk, what investors are expecting, and all the real-world events that actually make prices move.
All right, let's open our first case file. We're calling this one the case of rising risk. Here's the situation. We've got a security and its price has just mysteriously plummeted. Our job is to figure out why, and we're going to use one of our most trusted tools to do it, the Capital Asset Pricing Model, or as you probably know it, KPM.
Okay, so here's the initial evidence. What we know so far. The stock is trading at $52, with an expected return of about 12.1%. We also have our baseline numbers, the risk-free rate and the market risk premium. These are the cold, hard facts before the mystery really begins.
And here it is, the plot twist. A new piece of information comes to light. The stock's correlation with the market, which is a really key way we measure its riskiness, suddenly doubles. Just like that. So how does this one single clue change the entire picture? And what does it do to the price? Okay, let's follow the breadcrumbs and crack this case. Using CAPM, we first figure out the stock's initial risk profile, its beta. You can think of beta as just a number that tells us how much the stock tends to move compared to the overall market. So initially, it's about 1.1. Now, when that correlation doubles, the beta doubles right along with it, jumping to 2.2. And this is where it gets really interesting, because higher risk means investors are going to demand a much higher return. So the new required return skyrockets to over 20%. And here's the golden rule, right? When the return investors require goes up, the price they're willing to pay has to go down. And boom, there's our answer. The price just tanks from $52 all the way down to $31.15. The case of the vanishing value is solved. And the culprit? It wasn't a bad earnings report. It was a sudden, dramatic increase in how risky the market thought it was.
All right, for our next case, we're going to zoom out a bit. We're moving away from a single stock to try and read the mood of the entire market. How can we tell if investors are feeling optimistic or maybe a little fearful? Well, we're going to use a special clue called the confidence index, and we can figure it out by looking at bond yields.
So here's our data. We have the yields for these super safe, top-rated corporate bonds, and then the yields for these slightly riskier, intermediate-grade bonds. We have this for both this year and last year. Now, the key is hidden in the spread, the gap between these two numbers. A smaller gap usually suggests confidence. A wider gap, well, that suggests fear.
First, let's establish a baseline. Last year, the confidence index, which is just the top-rated yield divided by the intermediate grade yield, was sitting at about 0.85. This year, however, look at that drop. The index has fallen to just under 0.69. So what does this tell us? It's a pretty clear signal that investor confidence is fading. That gap between what they demand for safe bonds versus riskier ones is getting wider. In other words, people are getting nervous.
Now for our final and, I think, most dramatic case. Imagine this. Two companies, we'll call them Apex and BPEX, are locked in a huge patent infringement lawsuit. The jury just came back with a verdict. Now here's the catch. We don't have the news report yet. All we have is the stock ticker. Can we actually figure out who won just by looking at the numbers?
Okay, this right here is the crucial evidence. On the left, you've got how the stocks should have performed on a day like this, based on an index model. On the right, you see how they actually did. The entire truth is hidden in that difference.
And here is what we call the surprise. Look at Apex. It dramatically underperformed what it was predicted to do. It should have been up over 5%, but it only managed 3.7. BPEX, on the other hand, did the opposite. It outperformed its prediction. The market expected about 2.3%, and it delivered over 3%. It's really simple when you look at it. One company delivered a negative surprise, and the other delivered a positive one.
Based on this evidence, our verdict is clear. The market's reaction tells us everything we need to know. That positive shock for BTEX and the negative one for Apex can only mean one thing.
BTEX won the lawsuit. The ticker tape told us the story before the headlines even could.
So we've seen how powerful these models can be, right? I mean, they help us solve mysteries and really get a feel for the market's logic. But any good detective knows the limits of their tools. And our models, well, they're not crystal balls.
So what do you do when the clues just don't add up? When you run the analysis, you follow all the right steps, but the result you get just doesn't match what you're actually seeing in the real world. Well, consider this final puzzle. We have a portfolio where the CAPM model predicts, based on its risk, that it should have an expected return of over 16%, but the market is only giving it a 15% return. You see, there's a contradiction in the evidence. The model says one thing, but reality says another. And I think this leads us to the biggest takeaway of all. Financial models, they are an absolutely essential map for navigating the market. They give us structure, they give us logic, a way to interpret the clues. But the map is not the territory. It's a simplification of a very complex, very messy reality. And sometimes the real world just doesn't follow the plan. And maybe, just maybe, recognizing that is the most important clue of all.